Good morning. I'm Vince Lancy. This is the Gold Fix Market Rundown, and we're going to be making sense of today. A lot to talk about. Uh, there are two stories that we will be talking about in general before we actually make sense of today, and those are as follows. As of yesterday, crude oil is already pricing in a full 1 month Hormuz shutdown. And if LNG flows are hit, as they seemingly are, the real volatility may show up in European gas, not oil. As of today, fears are no longer of a bigger disruption. They are growing into an even bigger disruption. The second story is airspace closures over Iran are temporarily choking Dubai's bullion pipeline, shifting the immediate gold story from physical logistics to financial safe haven flows. Let's start with the markets. 10-year yields are up almost 6 basis points. That's not bearish for gold. The dollar is 99.12, up 58. That's not bearish for gold today. The S&P 500 is 67.83, down 92. Again, not bearish for gold. NASDAQ 24,531, down 403. Same idea here. Gold 51.92, down $129, well off its lows, but still getting slammed. Silver 82.56, well off its lows, but down $6.66, give or take. Copper down 15 cents, 2.5%. That's stagflation. WTI up $5 at 76.21, stagflation. Natural gas 331, up 13 cents, more stagflation. Platinum, industrially speaking, down $210. Palladium, industrially speaking, down $89. Gold silver ratio up over 3. Grains are unchanged bid, with wheat up the most. Wheat's geopolitical. You can look at it that way. And you can take a look at the rest. Bitcoin taking it on the chin again. All right. Let's get to the stories, and then we'll get to making sense of what is going on. There are the front page stories right there. And let's start. First off, Goldman estimates crude is already pricing in an $18 per barrel geopolitical risk premium, roughly equivalent to a 1 month full shutdown of the Strait of Hormuz with partial offsets. About 1/5 of global oil and nearly 19% of LNG transit the Strait. Now, that was yesterday. So now you could basically say oil is discounting about $23 of risk, which would put it out to about a month and a half. So the problem that I described yesterday, so briefly, this is doing this a little bit now. Okay, the market's going up more, but this is happening a little bit. So the stagflation fears are very real and they're spreading. And I promise you, we're going to make sense of this for you, at least in how we operate, and give you some basis on how to think about this going forward. Second story, gold shipments through Dubai are severely curtailed after airlines suspended regional routes amid Iran-related strikes. While the disruption may prove temporary, Dubai is a critical conduit to Switzerland, India, and Hong Kong. It's really a conduit from those places. Traders expect safe haven demand to dominate early price action, with futures and OTC markets leading. There is no safe haven demand right now. Again, we'll come to it. Later on today, 10 a.m., we're going to be putting out a piece called Geopolitical, Iran as continuation of Venezuela. About a month and a half ago, Eric Young and I had a podcast. It was wildly popular. It was titled The New Monroe Doctrine. And we laid out our theory of what was happening. And it started with Venezuelan oil disruptions to China. And it continues with Iran oil disruptions to China. And Iran's got a lot more going on. It's not just China. But the China factor is a denial of, a DDoS effect, denial of service. Well, this is a denial of commodity service. It's a DOCS, DOCS. All right. That's coming out at 10 a.m. And if you're trying to get a handle on the bigger picture, how this fits in with the geopolitical aspect, with oil as the point of the spear and silver somewhat back from that, and gold right in there as well, well, then this is the thing to watch. Jobs today. No, not today. Jobs this week. That's on Friday. Today's Tuesday. Fed President John Williams remarks, and Fed President Neil Kashkari has an interview. Nothing special there. And there's the story that we're talking about. Okay. Let's pull up a couple charts, and then we'll go through the explanation in a premium fashion. So there's silver, well off the lows, but small consolation. There's gold, similar picture. And there's oil. All three of these seemingly be contradicting each other. Oil is up because of the war, gold is down because of why, and silver is down because of stagflation. So let's start with what actually matters right now. Why gold and silver are getting crushed while oil is rallying. This is not random. This is not emotional noise. It's not manipulation. It's opportunistic, don't get me wrong, but it's not manipulation. It's panic. This is the market discounting two different things at the same time. Remember, oil is extremely efficient. The US has telegraphed that another potentially larger barrage is coming. The market, whether it's right or wrong, believes that this next move could effectively end the current phase of escalation with Iran. That expectation is why gold is selling off. Gold is discounting the idea that we are closer to the end of the escalation cycle than the beginning. This is not new. This happens a lot. Oil, on the other hand, is doing something very different. Oil is pricing the risk of disruption before that happens. It is pricing the possibility of refinery damage, increasing possibility of refinery damage, trade route disruption, or a straight style choke point event during what could be Iran's final reaction, their final attempt to just scorch the earth, so to speak. Oil is discounting supply risk in real time. So gold is discounting resolution. Oil is discounting disruption. Oil is not discounting peace. Oil is discounting disruption that will come before peace. Gold is all the cheap money running, abandoning the ship, so to speak. Oh, this is going to be the big one. We're going to blow it up. It's going to be the big one. Now, I'll tell you why that might not happen, but this is how it works. Silver is getting hammered for both reasons. Silver is industrial. In a stagflationary setup, higher energy costs means slower industrial activity. At the same time, if gold is pulling back because the market thinks escalation ends soon, silver does not get safe haven support either. It gets hit from both sides. This is classic stagflation war behavior. This is our fourth war. Oil up, broad commodities down, industrial metals weak, defensive metals confused. That's what silver is. It's confused right now. We've seen this before, multiple Middle East conflicts, even Brexit. The initial move is not about the long-term outcome. It's about what the market believes the next escalation does to supply chains and conflict duration. Okay? Now,